Markus, so whether it's a trade war or it's the economic data this week, will this just all force the Fed's hand?
Oh, absolutely. In fact, I would say any story you can come up with right now always ends up in more Fed rate cuts. It's quite amazing. If the economy really weakens, then the pressure will increase on the Fed to do something. And what can they do? More rate cuts and eventually go into QE. Even if the economy were to strengthen right now, and let's say we would see a decoupling of the treasury market from the rest of the world, which I don't foresee, and bond yields would rise, it would threaten the nascent recovery in the housing market. It would potentially start the classic recession-style domino effect of companies not being able to service their debt at rising bond yields and rising interest rates, and the default cycle starting, layoffs starting, and that's actually the classic way of getting into a recession. Any way you look right now are reasons for the Fed to keep cutting interest rates, and I think at least the way they talk right now, I think they're really not understanding what environment we're in, and we haven't even seen the start of QE in Europe yet.
Markus, one of the things that we've seen recently, and obviously it's very different and it's a technical market, but we did see it in the repo market, and that's this concern and question about whether the Fed has lost control of parts of the curve. Is there some fear out there that if we do see the need for kind of emergency Fed action, that it then becomes apparent that central banks do not have the tools they need when a recession or anything else should happen?
Well, whether central banks have the tools to do something about the next slowdown, I think that's a different one. We probably have to actually go through it and see what will happen. But it's clear to me that the Fed has lost control over the yield curve, right? And in order to regain control in this environment that we're in right now, it's almost like the usual laws of economics and markets are reversed. What we now need to see from the Fed is actually more rate cuts than priced in right now. That's the only way the Fed can get control of the curve again and can start to influence the yield curve. Right now, for example, we really would like the curve to steepen, which would encourage banks to lend. But the Fed is so far behind the curve right now, we need to see another 4, 5, maybe even 6 rate cuts, most likely, for that to happen. And again, I said to Shery earlier, we haven't even seen the start of ECB QE yet, which is likely to push all yields in Europe below zero. And that will also create an enormous pull on the treasury market and pull yields down here as well. So I wouldn't be surprised if the 10-year in the US, for example, is at 1% next summer, which means the Fed has to go to 50 basis points to regain some kind of control of the yield curve.